Smart money is what moves these markets. The dumb money gives everything to the smart money, and they're the ones that manipulate the price. Now think about it. If you knew that millions of dollars were put on the line to push price in a certain direction, wouldn't you want to trade in the same direction? Well, there is a tool that we can use to identify when the big players are actually gearing up to push price in a certain direction. It's called CVD divergences. And today I'm going to be walking you through how to use these tools to get into juicy trades like the one you see right now. So make sure to like the video, subscribe to the channel, and click that bell for notifications because we are bringing you the juiciest trading strategy videos here on YouTube. Now I have here a website called coinalyze.net. It's a free tool. You can go to the website, you can create an account, and what you're going to do is you're going to turn on two indicators. It looks like TradingView. It's not TradingView, it's its own website. The two indicators that you are going to turn on is number one, open interest. So come over to indicators and search for open interest. Go ahead and click that on. And then you're going to search for CVD. All right, CVD. You're going to go ahead and turn on that cumulative volume delta. So in order to understand how a CVD divergence works, we first need to understand the basics of how price moves. So essentially, price is moved by the active participation in the market. If there are more buys than sells, the price goes up. Doesn't that make sense? If more people are buying something, it makes the value go up. If there are more sells than buys, the price goes down. Right? This is very, very simple. What we are doing when we are looking for CVD divergences is we are looking for things that don't make sense. We're looking for a discrepancy in this secret formula. Top secret formula. If, let's say, for example, there's more buys than sells, but the price is going down. Let's say that there's more sells than buys, but the price is going up. We can see here that something's not right because we've already established that the market is moved by the buyers and the sellers. So if we see more buys than sells, we would expect that price goes up. Logically, we can say that if there are more buyers than sellers, and yet the price continues to go down, there's another variable at play here. We'll call it variable X. And if there's more sells than buys, but the price is going up, there's another variable at play here. We'll call it variable X. So we need to solve for X. More buys than sells plus X equals price is going down. That's where the CVD divergence comes into play. That variable X is actually the smart money, the market makers that are filling up big orders in the opposite direction of the retail traders that are marketing into trades at certain places on the chart. So for example, if we know that price is in an uptrend like this, and it's making higher highs and higher lows, and then all of a sudden we notice that price starts to make lower lows, and we can see on the order book that although price is making lower lows, we know that there's a lot more people entering into long trades right here than there were right here. We can solve for that variable X and see, yes, there's more people longing here than there were longing way up here, and yet the price is unable to make a higher high. The only explanation for this is that whales, their limit orders, are actually being filled by the retail traders marketing into trades. And the way we can identify this is by looking at our two indicators, open interest and CVD. Now, open interest and CVD I have right down here. What is open interest? Open interest is this one right here. I'll actually make it big for you. Actually, can I make it big? Yeah, I think I can. Double click it. Open interest is telling us are trades opening or are trades closing. It does not tell you what direction the trades are opening in. So if open interest is getting higher over time, that means more trades are opening up as price moves. What does this mean? If you see a strong downtrend where price is getting a big move down, and you see a big increase in open interest, you can infer that because there are more trades opening and price is going down, that shorts are opening. If price is getting a big move up and you see that there's a big increase in open interest, well, you can infer that these are long trades opening up. Contrast that to something like a short squeeze. If price is getting a huge move to the upside and yet trades are closing out, well, it's a short squeeze, right? Price is moving up because shorts are getting wrecked, not because new longs are opening. And the opposite is also true. If price is dumping like crazy, but the open interest is going down over time, this is a long squeeze, right? Longs are closing out, they're getting wrecked, their stop losses are getting hit. It's not new shorts opening up. Now, the open interest tells us, are traders opening positions or closing positions? The CVD is telling us what direction are those trades actually opening up in. For example, when we see this big move to the upside, we see the open interest is increasing. And we can see, based on the CVD getting higher, these are long trades opening. If the CVD line is getting higher and the open interest is increasing, this means new longs are coming into the market. Now, if the CVD is getting lower, like it is right here, and open interest is increasing, that means there are more shorts opening up in the market. Now, it's very important when we're looking at CVD and open interest that we understand the CVD alone cannot tell us whether or not new traders are opening positions. Because we might see CVD come way down and think to ourselves, oh, lots of shorts. But the open interest tells us otherwise. There's no new shorts opening here. It's actually just longs closing out of positions. Now, this is very important because, again, this allows us to see what is happening live in real time when price gets to a certain level. So because the CVD and the open interest work together to tell us who's entering trades and in what direction, if we see that price, for example, once again, is making a lower high, and we see that our open interest is getting higher over time. Okay, we see the open interest is getting higher over time, and we also see that the CVD is getting higher over time. What does this tell us? This tells us there's new traders opening up positions, because remember, open interest are trades opening or trades closing. And we know that the traders that are opening up are longs because the CVD line is getting higher. Remember, when the CVD line goes higher, that means longs are opening. When the CVD line goes lower, that means shorts are opening. So when we look at this right here, we can see that there are longs opening up. There are more longs opening up right here than there were open right here. Yet the price is making a lower high. The only explanation, once again, is that there's a whale. All right? Let's draw a whale here. And this whale is sitting here with a limit order. Okay, now remember, if I'm looking to sell something, I need a buyer. And if I'm looking to buy something, I need a seller. This whale wants to sell, all right? He wants to sell. In order for him to sell, he needs somebody who wants to buy. Well, this whale sees right here, hey, there's a lot of retail traders looking to buy, and I'm trying to sell. I have a lot of people right now. I have a lot of potential customers to sell to. So what does the whale do? He sets limit orders up here. And as the retail traders are entering into their longs, they're filling up this whale's big limit short, okay? Let's say, for example, that the whale has a short of $1,000, all right? Just for simplicity's sake, okay? So this whale has a limit order for $1,000. The retail traders are FOMOing long with their small money, right? You got 10 retail traders longing $100, $100, $100, and they do it 10 times. Once you have 10 retail traders longing $100 worth, this whale, he's totally filled up. And now all he has to do is add a little bit more to that short trade, and boom, the price will come back down. Now I'm going to show you some examples of this, how it would actually look on the chart, and a few great examples we've had in the recent past so that you can learn how to identify this and implement it into your own trading. Let's start with this big move that we got from right here. Now, this was a short trade I actually took. I live streamed it a few days ago. I'm no longer in it, but you can see I shorted from this lower high right here, okay? From this lower high right here that I have circled. Why did I take a short trade from there? Well, we did have a technical level there, which was the Fibonacci 618786 level that we had right here. So you should always be looking for these kinds of things at key levels on the chart. But here's what's important. As price is making this lower high, we're seeing two very important things. Number one, the open interest is getting higher over time. What is this telling us? This is telling us trades are opening up. Now, price is making a lower high and trades are opening up. So we might think to ourselves, are these shorts opening up? But when we look at our CVD indicator, it's telling us actually, no, it's long trades that are opening up because as the price is making that lower high, the CVD is making a higher high. What is the only explanation for more longs than shorts, and yet price makes a lower high and gets a rejection? Once again, the only explanation is a whale is up here filling up their limit short orders. Again, let's say the whale has $100 of a limit short order. The retail trader, they're trying hard to push the price up. They're longing, they're putting their $1 trades on, right? But every time they enter that $1 trade, it's not pushing the price higher because you can think of this limit order as a basket that's being filled up with all those long trades. And once this basket is full, now the big money, now the smart money is in control. And all they have to do is short a little bit more and bam, the price comes down lower. And once this happens and the price comes down lower, we get a very, very powerful move. Why? Because everybody who longed here is immediately wrecked. Look at the big drop of open interest. This is all the longs that opened up here getting stopped out. So it can lead to a very fast and powerful move. It can be a very fast gain. This is what chart? This is the 15-minute chart. Okay, look at that candle. In just 5 minutes, honestly, it happened. In 5 minutes, this massive drop to the downside. Okay, this is what you want to look out for. Let's see if we see any other examples here. All right. Do we see any other examples? Aha, I see another example right here. Look at this. All right, so we saw price making a lower high right about here. And we saw the CVD making a higher high. And we saw the open interest also making a higher high. Now, what happened here? We got to move to the downside of about 1%. Now, again, this is the 5-minute time frame. This is a strategy that you can use for scalping, day trading. We got to move to the downside when we saw this happen. And in my opinion, a 1% move is more than an acceptable scalp. This is what we want to look for. We want to look for more longs than shorts, yet price is making a lower high. So these are called bearish CVD divergences. They are also known as bearish absorption. One thing that will really help you trade using this method is only taking trades when price comes to a key level of support or resistance. You don't necessarily want to be taking trades willy-nilly from anywhere using this strategy. Now let's take an example of a bullish divergence. Right here, we can see that price is making a higher low. But if we take a look at our CVD and our open interest, we can see that CVD is getting lower over time. And we also see that the open interest is getting higher over time. What does this tell us? Once again, this is telling us that there are more shorts than longs. People are trying to short the bottom of this move, but there's a bigger player here who's absorbing those retail traders, FOMOing short at the bottom. He's filling up a big long, and then bam, we get that big move to the upside. And notice this, after we get the big move to the upside, yeah, there's a lot of follow through, but it's actually new longs coming into the market as well, right? So we can know that this was not a short squeeze that happened. Even though we saw the bullish divergence at this low, this is actually not a short squeeze. This is real money coming to the market. And then we can actually have the confidence to continue to hold this to higher prices. And as we actually see the price continue to form here and making higher lows over time, we are seeing continued bullish divergences on the chart here, where we're continuing to see more shorts than longs, price continuing to make higher lows, which gives us even more confidence to hold the trade to even higher prices. So the more you see these things happen, right? If you long and then you see a bull flag, right? And in this bull flag, you are seeing bullish absorption where there's more shorts than longs, but the price in the bull flag continues to make higher lows. You can be pretty confident that that's going to break to the upside. So this is a very powerful tool where basically you can catch the bottom of the move by looking for those CVD divergences. You can tell right here we're going to keep going up because of the CVD divergences. And then I actually didn't even take a short on Bitcoin until we came up to this level because of the bearish CVD divergences.